Well, good afternoon. This is Michael Douville coming to you from beautiful Scottsdale, Arizona. We are just watching history unfold before our very eyes. We've been talking ad infinitum in my lectures, in my articles that have been written, and in the videos that we have. We are going to have volatility and risk entering a lot of marketplaces, and sure enough, here they are. So I want to tell you that one of the things that we've been talking about that's going to be adding some risk to the marketplace would be a rising dollar. And for sure, here we see it. So some of the analysts that I follow, Walter Zimmerman, Martin Armstrong, Charles Nenner, all have been saying that we are going to be reaching for a stronger dollar. And this is in contrary to a lot of other analysts. And sure enough, here we are. We're getting stronger dollars. Now, I talked to Walter Zimmerman 2, 3, 4 weeks ago in the early part of March, and of course we were talking about the U.S. dollar was at that time around 88 on the index. It's now at 92. So it's moved up a full 5% in 4 or 5 weeks. And his target was 103.8, which would be a significant rise. But also keep this in mind that he thought it might spike beyond 103.8. If it went past 103.8, we were going to get a spike, and we're going to get a pretty strong spike. And that spike, of course, would be very, very perilous for a lot of markets around the world. And, of course, particularly the emerging markets, because the emerging markets, of course, a lot of them are very debt dependent. They're very highly leveraged. And of course, a lot of this leverage is denominated in dollars. And so with the falling dollar, which has been what's been going on for the last few years, if you borrow $100 and you have a dollar that declines, you end up paying back 80. So what a great deal that is. But now that works in the opposite direction too. So if you borrow 100 and a dollar strengthens, you could end up not only paying the interest, but you're paying 120 back, whatever the dollar has gone up. And of course, if it spikes, it could be really, really tough. Also, these emerging market countries like Indonesia and Thailand and even Canada, which of course is a big commodity, they're commodity exporters. So as the commodities are all expressed in U.S. dollars, as the dollar gets stronger, that means it is less in local currency. So instead of getting more for their money, they're actually getting less. And as the dollar gets stronger, that means that oil prices will go down, lumber prices will go down, copper will go down, coal will go down, and a lot of iron ore. And of course, a lot of these countries this is their exporting, and it's going to get less. And of course, as the U.S. dollar gets stronger, and it'll slow the economies, and demand will slow off. So not only will prices go down, but the demand component for prices will also go down. So it can be reasonably significant. So I want to talk to you that these things are risks that are entering into the marketplace. They're going to affect an awful lot of asset classes. So we're certainly talking about the fact that the real estate, which is my asset class, has a jeopardy period for the next year and a half, caused by extraneous influences, and it's just a timing problem. And of course, we're right there. So if we're kind of on the cliff, just waiting for someone to push us over, and these are the type of things that would push us over. So we're very, very cautious at this juncture. And of course, we have rising interest rates. Rising interest rates are very, very difficult for the bond market. They're just, rising interest rates will certainly hurt the bond market. There's just there's an inverse relationship. So as interest rates go up, bond prices go down. And as interest rates go up, it makes it more difficult for entities to pay back the loans. And keep in mind, particularly if you couple that with a higher dollar, so you're going to have sovereign debt problems. You have problems with countries, not only their exports or their commodity exports are having trouble getting their assets are going to be certainly affected, their cash flow affected, but now they're going to struggle paying back their loans. And of course, it causes defaults. So, when they start struggling and quite honestly, they're having trouble paying now. So as interest rates go up, it really makes it onerous. So they may be left the choice, either I keep the lights on for the population or I pay the debt. They're probably going to keep the lights on. So as the debt gets defaulted, it adds risk to the marketplace. As we get risk to the marketplace, interest rates go up. It causes kind of a spiral. So if you're in bonds, you have to be really, really careful. And if you're in sovereign debt bonds, I mean, talking about worldwide, we're talking about even like Bavaria and Germany and Portugal, Spain, Indonesia, Thailand. A lot of these places are struggling to pay the debt. And of course, here in America, we have states that are having trouble. So you really have to be careful. Not only do you have interest rates rising, but you also have credit risk. And of course, when you have problems like this, the economy starts slowing down. It's very, very tough on stocks. And also becomes as the dollar gets stronger, that means that you're earning less in U.S. dollars. So if you sell a euro, you sell one of your cars for 10,000 euros in Germany, why that used to translate into like $11,000. Now, if you sell a euro in Germany for 10,000 euros, it could just be $10,000. It could be, they lose 20% or so. And that goes into their profits. So they're selling the same car, but the profits become less just because of the difference in the currency trading. So what I'm saying to you is that it is time to really pay attention. It's time to raise cash. It's time to get out of debt. We've been talking about getting out of debt for a really, really long time. It's now to get really serious about getting out of debt and start raising some cash. So we'd like to see you have some cash in the house, like to see cash in the bank. And let's start paying off all these little nuisance debts that we have, and let's start putting some money on the side. So my very, very best to you, and God bless you. Bye-bye now.